This is the Dynamite Podcast, where we give you the strategies and mindset to take control of your life and achieve financial and philosophical freedom. As David Geffen says, we are each the figment of our own imagination, and some people have a greater ability to imagine than others. This is episode 2 of a 3-part series detailing actionable steps to become a real estate millionaire. In this episode, you're going to learn how to start to finish navigate a real estate transaction, how to assemble your team, how to use your team to structure an offer. We're going to cover terminology and what to expect from start to finish. My name is Tim Gurule, and I'm an entrepreneur on the journey of seeking freedom. I've lost everything for standing up for my beliefs, and now I'm building passive income so I never have to compromise my values for a paycheck. This podcast is your roadmap to earn your own autonomy. So if you want to remove your limiting beliefs, unlock a fruitful life, and truly become free, join me and let's get to the next level. All right, guys, welcome in for part 2 in this 3-part series. If you missed part 1, I would encourage you to go back, listen to episode number 80, where I explain how to leverage bank debt in easy, actionable steps to get started. We talk about inflation, we talk about loan paydown, appreciation of your asset, and ultimately, we talk about why bank debt is such a powerful weapon when you're first getting started. If you don't have a ton of money, you don't have a ton of knowledge or time, you don't have a huge real estate network, leveraging bank debt is just such a powerhouse of a tool that gets so often overlooked. We're going to cover start to finish everything that you need to know as a guide throughout the entire process for purchasing a residential property. And then in episode 3, not next week, but the week after next, we're going to bust some common myths and misconceptions. We're going to answer common questions that I get from people reaching out to me on social media or from the podcast. And we're going to talk strategy. We're going to talk fun things like seller financing, the whole gambit. So my goal for you is to leave this series with everything that you need to start your journey of becoming a real estate millionaire. So let's just do a quick recap. Previous episode. All right. In the previous episodes, we talked about using your primary residence and the financing that you get with that to hack your way into growing a real estate portfolio. So if you remember, there's this amazing thing called leverage that the bank gets you, which is phenomenal. It's just this superpower when you're first getting started. The bank essentially says, hey, if you're going to live in this house, the U.S. government incentivizes homeownership, and they give you the majority of the cash or leverage to go purchase this home. Most of us don't have $500,000 sitting around in a bank account to go buy a house. So they say, hey, I'm going to give you 95 to 97% of the money required to purchase that house. All right. You're going to live in that house for a year, save up money for an additional down payment. And the guidelines state that after you reside in that residence for 1 year, you can move out, use that existing property as a rental property. We can offset the debt of that mortgage with the new rental income, and you can qualify to go buy an additional house. And guess what? Because this new house is, once again, a primary residence, you get that financing of 95% leverage or 5% down. And we just keep doing this every single year, again and again, as we build that portfolio. And this is where the compounding effect of that appreciation, the loan pay down, and of course, how inflation sprinkled on top is just this 1-2 punch to become a real estate millionaire, really without doing anything crazy, but just being diligent over time. So that's what episode number 80 was. If you're missing some of the puzzle pieces, go back and check out 80. This episode, we're going to talk really tactical. We're going to start the episode off talking about how to assemble your team. Okay, so we know the benefit of this bank leverage. We know what we need to do. We know why we want to do it. The next step is, well, how do we do it? Okay, so this episode is going to be start to finish, how we're going to get through the transaction, what to expect, terminology, so on and so forth. But the first thing that you need to do is start to assemble your team. Before you go out into this world of real estate, we don't want to be flying blind. We need to go find a team, rock stars that can get us through the hard times, that can answer questions for us, that are going to be just like pit bulls on a leash that we have to pull back and are fighting for us to have the best positive outcome. So how do we assemble this team? And who are some of the members that we need to assemble on that team? And then after that, we're going to cover start to finish. So I would like to start with just some basic players here. You're going to have your realtor, right? This is the person who's going out, taking you shopping, helping you make offers, writing up the contracts. We're going to have your mortgage advisor. This is the person who's helping you figure out how much you're qualifying for, figuring out the financing, shopping banks for you. The realtor and that mortgage lender team, they're going to have a whole toolbox of people that they like to use for inspections. They're going to have title companies that they're comfortable with. The real estate transaction is very complex. It's simple to some degree, but there's a lot of moving pieces. And what they do is they keep the transaction on time. They make sure that all the T's are crossed, I's are dotted. And so you really want a good, strong team. Now, you cannot walk down the street in your neighborhood and not run into 10 realtors. Everybody and their mother is in the real estate industry. And this is where I really want to drive home, finding a good, solid team. You don't just want any realtor, you want a rock star. You want somebody who understands the market, understands your needs, has been through ups and downs, is willing to stand in and fight, understands how to structure and offer appropriately for you. I have seen countless examples of people using their mother-in-law or their friend who has their license. It's been on hold. They've done one transaction in the last 5 years. And I'm not saying there's anything wrong with that, but we are separating ourselves from the common buyer now, and we are using real estate as an asset to grow our wealth. So who you choose to assemble on your team really freaking matters. All right. So when I first started buying my own properties, when I was building my own portfolio, I had no knowledge of how to do this, okay? I used friends that had just recently gotten their license, and I loved it. Honestly, I wouldn't have changed it. Like looking back, it was a really good friend of mine from college, and that was an adventure for both of us, learning that first transaction together, and I loved supporting his business. But keep in mind, during that phase of life, I was not a real estate investor. I was just a guy buying my first house, okay? And so when we start to make the decision of we're going to use real estate to grow our wealth long term, we really need to start assembling a team of professional A-grade players. All right. I've told you guys in previous podcast episodes, I literally had read books on how to start investing in real estate. And after I had bought my primary residence, I flew across the country to a market that I had researched with these books in tow. And I would open up the books chapter by chapter, and I would ask questions to assemble my team. So here I am, this nerdy dude who knows nothing about real estate, walking around with books, flipping to chapter 3 because it was the next phase of the meeting, and I had to figure out what the book was telling me to say. So when you are interviewing realtors, when you're interviewing people to be on your team, you want to ask some really critical questions, all right? And this is embarrassing. When I flew out to this market across the country to go find my team, I would line up all these meetings. So before I even got there, I called 10 different brokerages, and I had 3 meetings a day lined up for the long extended weekend. And I would interview them when I showed up. Some of them I tried to do over the phone, but obviously it's hard to do all of it over the phone. So I'd show up, I'd open my book, and I would ask them a series of questions, just like how the book told me to ask them. I believe the book I was reading was How to Retire Early on Real Estate. Some of the most important questions that you need to ask. And before we even get into that, why is it important to interview your realtor? Well, because they are representing you on one of the largest transactions that you're ever going to complete in your life. It's really easy to just brush it aside and say, well, yeah, they're helping me buy a house. I know this person, they're my friend, it's not a big deal. Okay, when we reframe it and say, okay, this person is helping you navigate a transaction worth in excess of $500,000, it starts to become really important that they know what they're doing. So some of the common questions that I still ask realtors to this day when I start working with them, when I refer them a client, or when I start investing in a market that's not in an area that I have a network in, I will call the realtor and I will ask them a series of questions. And some of those questions include, how long have you been doing this? What is your specialty? What is your niche? Are you a full-time or a part-time agent? You really want people who are full-time agents who are dialed in to the market. This person needs to know street by street, school by school, what's appreciating, what's gentrifying, where's the high crime areas. This person is helping you navigate this purchase. And if you're finding somebody that's doing this half in, you're going to get half results, okay? So just think about this. Do you do this full time? You can do with what you want with their answers. But me personally, I want a full-time agent. Now, this is where I started to really separate some of the agents in this next series of questioning, okay? And if you feel uncomfortable asking these questions, it's something you're just going to have to practice, because at the end of the day, these people work for you. This is your transaction, and you need to muster up the strength to dig through that discomfort and ask these good, hard questions. The next question I ask them is, do you own your own home? I want to know right now, have you ever been through this process before? Okay, because you can relate to it to me, empathize with me. Do you own your own home? The second question I ask is, do you invest in real estate? The third question, and this gets really uncomfortable for people, would you be willing to share the size and scope of your portfolio? What is your niche? What do you invest in? Why do you invest in this area? And I'm not saying if they don't invest in real estate, if they don't own their home, that they're not good agents. But what I am saying is you're looking for somebody who is in alignment with what you are trying to do, who understands your mission. And it is a lot easier to communicate with somebody or to accomplish what you're trying to accomplish from somebody who is A, familiar with the market, and B, a few steps ahead of you. That does not mean that they're not a good agent if they don't answer those questions how you want them to answer. But I will tell you, I personally, right, wrong, or indifferent, I filter agents into categories when I start investing in new markets. And you bet your bottom dollar that if they're not investing, if they're not in the business full time, if they don't have a portfolio, if they don't own their own home, it's going to impact my decision of whether or not I'm working with them. It's just the way it is. Now, when you're picking a mortgage advisor, I would ask them similar questions, okay? I would ask them, what is your specialty? What's your typical buyer that you work with? Can you explain to me some of your fees? When you quote me interest rates, are you quoting me an interest rate with points? Are you willing to disclose your rates and show me that they are not with points? You want to know what's the total cost, because ultimately, all of these people are in sales to some degree. When you call them, they're going to try to sweet talk you into working with them. And we need to cut through the BS and get to the meat and potatoes of, are you the person to represent me or not? A lot of the questions that you ask a mortgage advisor are very similar to the questions that you ask a realtor. So what do these people do for you? Well, we talked about the realtor. The realtor will take you shopping. The realtor will do some research on the neighborhood, advise you on the neighborhood as much as they can within the legal limits. They will write offers for you. Really, they work with the mortgage advisor or the lender to strategize an offer based off of the data that we pull from the market. And I'll talk about that process in a minute. Mortgage advisors, okay? What does a mortgage advisor do for you? Well, they do a number of things. Really, they don't get as much recognition as they probably should for the transaction. I'm speaking obviously very much through the lens of a mortgage advisor myself, but ultimately, if the deal works, the mortgage advisor is just the guy that is the unsung hero that got it done. If the deal falls apart, he or she is instantly the villain. Essentially, all of the nuts and bolts and pieces of making this thing get across the finish line falls on the back of the mortgage advisor. The mortgage advisor works hand in hand with your realtor. They're doing research on the market, the neighborhood. How many days has the property been on the market? What should we offer over asking? We want solid pre-approvals. We're really structuring all of these things together to make sure that there's no leaks in the boat, that we're going to get across the finish line and everybody's going to sail off into the sunset happy, okay? There's a big difference between a warehouse lender and like a boutique mortgage advisor, and we'll cover that in just a minute. But the first and foremost thing that you're going to do with a mortgage advisor is you're going to sit down for a consultation, and they should be asking you, what are you trying to accomplish? What type of a home are you trying to buy? Is this for an investment property? They're trying to gather information to best serve you. If people aren't asking you those questions in these mortgage advisor meetings, you need to go find another advisor, because that is just a person who's clicking interest rates and thinking about the commission at the end of the day. It's not a person that's serving your best interest. So let's talk about a pre-approval. When you get through a consultation, the next step is you're going to start a loan application to get a pre-approval. It's like an IOU, okay? It's an IOU that says you are qualified to go shopping for the range of home price that you're looking for. It does a few things for you. Number one, you have a much stronger offer with a pre-approval. To be quite honest with you, a lot of people won't even let you go shopping. Realtors won't take you shopping without a pre-approval. It essentially says, hey, this person's not wasting my time. They're not just kicking tires. They're not looking at $1 million house when they can only afford a $200,000 house. They're serious, and we're going to take them serious, and we're going to take them shopping. It's important. It's the first step in the process. It helps you figure out how to make a plan. And if you're not where you want to be right now, it is a way to strategize a plan to get you where you need to go. It's completely free. Oftentimes, it takes less than 20 or 30 minutes to fill out one of these applications. There's no downside. There's only upside. It's just more information, right? So if you're looking to purchase in a certain price range and you're scared and you haven't applied because you're nervous, it's not doing you any benefit, right? Time kills deals. If we are not Johnny on the spot when an opportunity comes up and we're behind the 8 ball, we're working last minute to get a pre-approval, it's really unrealistic to think that we're going to get an offer accepted, especially in today's market where things move fast. If a good deal comes on the market, you want all your ducks in a row. And instead of burying your head in the sand, if you're not where you need to be, they will make you a plan to get you there. So like, for example, in my team, I have credit advisors. So if you have credit improvement that needs to be worked on, I have a person who specializes in building your credit up, which is really important in getting you a lower interest rate, which makes your monthly payment lower. We have a way to look at your tax returns and help make a plan if you're going to purchase next year of, hey, maybe talk with your CPA. Here's some numbers that we need to hit in order to qualify for the price point that you're looking at. We just compile all this information and put it together to work in your favor. All right. The next thing that mortgage advisors do is they really work for you. Okay. So they're behind the scenes and they're shopping every single bank out there. They're shopping for rate and terms. They're pricing banks against each other to get you the best rate, the best term, the best possible deal. That's really what they're doing. They're working really hard to go find you the best deal. The third thing that mortgage advisors do is we try to make it as fun and stress-free as possible, right? There's a ton of moving pieces. The financing is always stressful for people. It's one of the most stressful parts of the entire process. And we act as kind of a shield. As all these flaming arrows are coming at you, we really take the brunt of that and we go to work, solve the problems, put out the fires, and allow you to be freed up psychologically to just go about your process, your transaction, find a place that you want to live in, and we'll do all the dirty work, cleaning out the streets to make sure that you are ready for arrival when you get there. We're going to make it as pain-free as possible. I've heard people say that they would rather have a root canal than apply for a mortgage again, but there are ways to make it as stress-free as possible, and that's something that I really focus on doing. And the last thing that I really want to talk about that separates a mortgage advisor from like a big call center is, these big call centers, there's thousands of people. Let's just say Rocket Mortgage, for example. Okay. You call somebody at Rocket Mortgage, there's thousands of people there, or a big bank. Let's say you call Wells Fargo or Chase directly. These people, they're sitting in temporary positions, meaning they're working their way up the ladder. They're really not in a mortgage position for long term. And with Rocket Mortgage, for example, you call a big company like that has these call centers with thousands and thousands of call takers. The next time that you call them, it's really unlikely you're going to get the same person on the phone again. It's difficult to work with. There's no long-term strategy for listening to what you're trying to accomplish and sitting with you in the long term. It's really just like, let's find the cheapest junk product out there and put you in it. And honestly, you get what you pay for. Versus a mortgage advisor is going to intimately sit down, get to learn about you, know about you, figure out what you're trying to accomplish, and they're with you for the long run. A mortgage advisor is like a wealth advisor, and they're helping you make a plan to supplement wealth at retirement age using real estate. So what does that mean? That means it's not just a single transaction. That means that they've listened to your goals and desires, and they are keeping tabs on you and your file and your portfolio. So when the market goes up or down, they're reaching out and notifying you. If you have sufficient equity in your property, and they know that you want to pull cash and buy another property or start your own business, they're letting you know, hey, based on what we're seeing in the market, trends and economic data, here's something to be thinking about in the next 6 months. They're calling you, they're notifying you, they're keeping tabs on you when interest rates drop. They're right there with you step by step through the process. It's a long-term relationship and they have your best interest in mind. So that's really what separates big call centers from boutique mortgage advisors. So after you've assembled your team, you've asked these very critical questions of each of these positions, realtors, mortgage advisors. We've assembled our team now, and we've set our expectations with our realtor, what we expect from them, what we're looking for. And we've sat down with our mortgage advisor and we've done a pre-approval consultation. We're pre-approved. The next step in the process is we can go shopping. So Now that we're going shopping, what starts to happen is we're making offers. So we have these parameters of what we're looking for. Let's say it's a primary residence. Let's say you're going to move out of it and make it into a rental property one day. Regardless, we know what we're looking for. So we're out and we're making offers. And this is where the mortgage advisor and the realtor really start working together. When there's a property that you're really interested in, you go out and see it, you like it. The next phase, the next step in this process is to write a formal offer. And if you have a rockstar team, a realtor and a lender that work together, they're going to cooperate on making that offer. They're going to look up how many days on market? What do we think it's worth? Is the list price competitive? Can we make a lower offer? Based on the days on market or the place in the market cycle we are, do we think that we can ask the seller for something called a concession credit? Meaning the seller gives a credit back to cover things like closing costs or mortgage insurance or cover an interest rate buy down. So the realtor and the mortgage advisor are going to work hand in hand to figure out these items and come out with the best possible scenario for you. Once we've structured an offer, you're going to sign some documents saying that you're agreeing to move forward with the purchase. We're going to submit the offer. When the seller of that property receives that offer, they're going to do a couple things. They're going to either A, reject it outright, like, no way, this is a lowball offer, we're not taking it. B, they're going to accept it. Yeah, we like the offer. We like the terms that you've offered. Let's go mutual. Or C, they're going to counter. Okay, meaning you're pretty close, but could you give up this? Or could you come up $5,000? Or instead of a concession, what if we drop the list price $5,000 and we don't give any concession? There's going to be some back and forth. This is a negotiation. We're working for a win-win. Once they counter or not, and you agree to the terms, they agree to the terms, what happens next in the process is we go what's called mutual. We have a mutually agreed upon contract, okay? So once we are mutual, the next step in the process is to open what we call escrow. So when you go mutual and you open escrow, there is risk for the seller to take that property off the market. When you go mutual, the seller is agreeing to say, hey, I'm not going to let anybody else buy this property. You have the right to buy this property, but there are some expectations that you complete to purchase the property. The seller assumes risk by taking the property off the market because when you pull the property off the market, number one, if the transaction falls through and they have to put it back on the market, it looks poorly on them. Why did the property not sell? Subsequent buyers could look at this property with a critical eye. Conversely, if they pull the property off the market for you to buy it, you end up just kicking tires. You're not a serious buyer. And they end up having to put the house back on the market. And in that time frame, the market has degraded, meaning the price of the home has come down. Well, now you've cost them money and you could be liable for those damages. So when we write a contract, a way to mitigate having to pay or being sued or litigated for those damages is to put things in the contract like that are called contingencies, okay? And a contingency is essentially just a clause in the contract that says, hey, we have full intention to purchase this home. However, if any of these things are not agreeable to us, we have the right to walk away from this purchase and get our money back. Now, I'm going to talk about what those things are in just a minute, but just like I told you, we're going to open up quote unquote escrow. What happens is oftentimes a buyer will have to write a check that's called an earnest money deposit. And this is just a way to ensure that you are a serious buyer. And it makes the seller feel good because if you don't do what you have agreed to do during this contract period, then they get to keep your earnest money. You forfeit that earnest money. Now, remember, I told you about these contingencies, and those are going to protect you and your earnest money. We're going to talk about those in 1 second. I want to cover escrow really quickly because a lot of people talk about escrow. We've opened escrow. What does that mean? It's a term that a lot of people hear about, but they don't necessarily understand what it means. So there's a couple things that need to happen during a real estate transaction. One of them is we need to check title, and I'll talk about that in a second. But escrow is a third-party service that essentially gathers all the information. They take documents, the earnest money deposit, the contract, and they make sure that everybody is doing what they say they're going to do. It's a way to protect the buyer and the seller throughout the entire transaction. So escrow is just a intermediary third party that essentially holds documents and earnest money to make sure that the transaction is completed, and they ensure that everybody does what they say they're going to do as they said they're going to do it throughout the transaction. So they hold that earnest money deposit because we don't want the seller to leave town with that earnest money check. And we're also holding the buyer responsible because they can't just reach into the pot, grab their money and bounce. They have to do what the contract says they're going to do. And some of those things, those contingencies that allow you to get your earnest money back include things like an inspection. They include things like an appraisal and, of course, financing. So when we write a contract, we're going to write this contract to include contingencies that say, hey, if while we're in escrow, it's typically a 30-day period. It could be shorter, it could be longer, but typically it's about 28 to 30 days, this escrow period. If any of these things are less than satisfactory, we have the right to take our money back and leave. Okay. And those things are, as soon as we're mutual, we're going to order an inspection on the house. Why do we do that? Well, when you buy a used car, you kick the tires, you look under the hood, you make sure the engine's not knocking. You want to know that you're not buying a lemon. So we call out a professional inspector. They crawl through the attic spaces. They're looking under sinks and bathrooms, and they look at the toilets, electrical outlets. They're making sure that the house is in workable, usable order. They're going to compile this entire inspection report. It's pages and pages, usually in a binder, take a bunch of pictures, and they're going to send it to you. Now, I will tell you, I have never in my life received an inspection report that came back with nothing wrong. The trick is to really lean on your rockstar team. Remember, this is why we hired a rockstar team, and ask them what their opinion is of the inspection based on the area. For example, the Pacific Northwest always has residual moisture, and they always have rodents that get into the underside of a house, and they tear out the plastic that holds in the insulation under the home. I have not come across an inspection report that does not include something like that. So just because you have little things that go wrong doesn't mean we should run for the hills. We really want to make good decisions. The inspection should really deter you from purchasing for major items like we have cracked or shifting foundation, we have structural beams that are not supporting load-bearing walls, things like that. The other thing that we're going to do is we're going to order an appraisal as soon as we can. And the reason that we order an appraisal is for a couple of reasons. Number one, the bank's not going to give you more money for the house than it's actually worth. And number two, you want to make sure that you're not overpaying. If you made an offer for $500,000 and the appraisal comes back at $300,000, there may be something here that we are not understanding. And we really just want to make sure that those things are remedied before we move forward. Now, there are instances where you are overpaying for a home. Let's say it's a really competitive market. We have a lot of buyers, and your team is advising you like, listen, I think this is a good idea. I know it's above what the appraisal is coming in at. Appraisals are lagging data, and they're based off of homes that have been recently sold. So essentially, an appraiser comes out, they look at square footage, they look at amenities, what conditions the house in, and then what properties in the area are similar and have recently sold. And then they use all that data to come up with an average. Now, sometimes when markets are appreciating really quickly, those appraisals, they come in low. And in those instances, in really competitive markets, your team may say, listen, I know the appraisal came in low. However, I know that this is what this property is worth right now. And you are given the option to cover that difference between the offer price and the appraisal amount. You're under no obligation to do that, but it's an option, especially in competitive markets. There's also things that we can put in your offer called escalation clauses. In super competitive markets, you can put this clause in your contract that essentially says, hey, if another bidder comes in, I really want this house, so I want to be $2,000 above whatever the highest bid is. So I'm submitting my offer for this up to this amount, meaning anybody that's bidding against you, your offer automatically escalates for that amount written in your contract up to a ceiling that you would identify via that contract. Okay, so we have the inspection report, we have the appraisal, and in the meantime, the title company, this is a whole other portion here, the title company is going to work on your title. Now, a title is essentially a chain of custody on your house. And what they do is they ensure that the address is correct, the parcel number is correct, and there's no liens or encumbrances. Meaning, let's say that the person who owned the home before you never paid a contractor for some work that they had done, and they put a lien against that house, and that lien has to get paid off before you can purchase the home, because you're not going to inherit a home with a lien on it. The bank, the mortgage advisor, they're not going to be able to make a loan on that home that has an encumbrance or a lien against it. Now, oftentimes the proceeds of that sale, the money that the seller is going to make, will go towards paying that lien off and you getting a clean title. But the title company is just making sure that the person that's selling it has the authority to do so. There's no liens or encumbrances. And they offer what's called title insurance policies. And these policies, there's two types of policies. There's a lender policy and a buyer's policy, okay? And what it does is it protects you against instances in future events. So let's say that the title company made a mistake surveying the parcel, meaning what they thought the boundary was actually, in fact, somebody else's property, and you get litigated. The neighbor starts to sue you because the boundary is not what you thought it was. Well, you could be liable for that, but under title insurance policies, and if the title company offers extended policies, I would encourage you to do it. You don't have to have a title insurance policy, but it's absolutely a good idea. It definitely protects you. In those instances, the title company would be liable for that delta, for that amount that would be owed in the event that there was some sort of title issue. So the title company comes back, they say, hey, title's clean, no encumbrances. The appraisal came in at or more than value. The inspection came back with no major issues. And all the while, in the background, the mortgage advisor is just busy behind the scenes finalizing your loan to fund. So they're putting all those documents together. You've already been pre-underwritten, but now what they're doing is they're taking all that information, they're compiling it and submitting it for final underwriting, meaning there's a team that's going to review everything that you told them to make sure it's true. The day before funding, they're going to do things like call your work to make sure that you're still, in fact, employed at the place that you submitted and you're still making money. There's no fraud attempts. They're just really double checking. Keep in mind, the bank's giving you the majority of the money to purchase this house, and they want to protect that. And once all those things are ready to go, good to go, we have final approval. At that point, the next thing that we're going to do is fund the loan, meaning you come in to close. We're going to get you into a title company, or we're going to send a mobile notary out to you, and you're going to get all of the final documents to sign on the dotted line and take ownership or possession of the home. And at this point, all the pain of finding the team and your realtor and lender asking you for documents and follow-up question after follow-up question, and you just thinking like, this is ridiculous, this is a terrible process, all of that terrible competition in the market and making multiple offers, this is where all of that is worth it. This is the fruit through the other side of the rainbow, because when you go in and you sign those documents, the escrow company, the escrow officer, she's going to look through all those documents to make sure that everything is signed correctly. Everybody has done what they said they're going to do. And at that point, when we have all the signatures, the loan is finalized and final underwriting, congratulations. You can exhale a sigh of relief and receive the keys to your brand new, beautiful home. Your brand new, beautiful home. And all of that headache and hard work will be worth it. So, a couple common questions about this process, and I'm sure I left some things out. I know we went pretty fast, 30 minutes for start to finish, every detail I could think of. Your earnest money is that promise that, hey, I promise I'm going to do what I say I'm going to do. That earnest money gets used towards the transaction. So whatever your cash to close is, the closing costs of that transaction, it's going to get debited. So if you put $5,000 into a earnest money deposit, that $5,000 is going to be used to reduce the overall closing costs. It's not going to reduce the closing cost amount. Let's say your closing costs were $25,000. You have $5,000 in earnest already. You're going to need to come with an additional $20,000 because that $5,000 in earnest can be contributed towards your closing costs. That's a common question I get from a lot of people. The other question that I get is, what are closing costs made up of? And I think we'll just wrap up with this one here. So closing costs are made up of a few things. Number one, the title company has their own fees. The appraisal company charges fees, right? If somebody comes out, these are third-party companies that have fees to do these transactions. There are taxes and insurance, and these are impounded. So we collect a few months worth of these upfront because oftentimes people pay their tax and insurance out of escrow, meaning you're not writing a separate check every month to pay your taxes or your insurance bill. You just make one mortgage payment to the bank. The bank impounds some escrow fees and they pay taxes and insurance for you. But in order to fund that loan up front, you need a couple months of those paid in advance. You're going to have the lender's fee, which often goes towards processing and underwriting. It's usually pretty minimal. It's oftentimes cheaper than the appraisal fee. And as far as your realtor fee, well, if you're a buyer, you actually don't pay that. And you also don't pay for your lender. Your realtor fee is paid for by the seller, although some things are changing. We're going to have to keep you up to date on some of the laws that are changing on how your realtor is getting paid. But as of right now today, by and large, buyers traditionally have not paid that. It's come from the seller side. And as far as the mortgage advisor, how they get paid, you don't pay them either. The mortgage advisor, what they do is after they close your loan, they hold it for a period of time, and then they sell that loan to a big bank. Could be Wells Fargo, could be Chase. And when they sell that loan to the big bank, pays the lender a fee for purchasing that loan, and that's how the lender gets paid. So you're actually, as a buyer, for the most part, not paying the lender or the realtor throughout this transaction. So that's a basic breakdown of fees, what to expect, start to finish, terminology. This is supposed to be just like really meat and potatoes, explanatory, strategic, and hopefully you feel armed and prepared to go purchase your first home. If you have any questions, just go ahead and DM me. You can find me on social media at Gurule Tim, and we will catch you all on the flip side. See you next week.